Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. Many things may have changed here over the course of this market's journey, but one thing has been constant, even now. Though I am the first to admit it has been tested as recently as last week. It is the lower time of the December 2020 to April 2021 bullish shift pitchfall, currently at 1755, and is still the core of the bullish support to this market. The April 2020 to date uptrend, currently at 1743, and the April 2021 to date uptrend, currently 1740, have both been reassigned because of last week's changeover drop. However, despite the lower time being breached last Monday, it was not broken, as the immediate bullish double on Tuesday proved, repairing itself and making a pipe bottom in the process. The rest of last week, as I said in a Sugar Week presentation on Thursday, was spent in filling in the substantial gap such that it was filled by close of business Thursday. Indeed, Thursday saw the market come up and hit and close on the major resistance of the medium moving average, currently at 1844. This is the first time it has done so since mid-July. The power of this moving average was seen in the opening level last Friday, opening well down and away from the medium moving average. However, the bullish incentive was very much still there, as the market made a bullish opening white Mariposa on Friday, closing clear over the medium moving average and at the level of the next significant resistance, the combination of the May to date downtrend currently at 1864 and the flatlining long moving average currently 1867. We also so nearly came close to making last week into a weekly key reversal up, though not quite. Then there's today's action upwards from the open, which would have made last week a weekly key reversal up if it had happened there. However, this simple push higher today, though we've since pulled back a bit, is highly symbolic. You see, we are now set with only 5 trading days of October behind us. That's 5 full trading days behind us. We are set to possibly make a monthly key reversal here in raw sugar. If we close on Monday the 31st of October, either above 1842 or under 1789, then we'd be on. Anything in between and would have a lesser outside month pattern. This now brings me to the 2 main patterns I've been discussing in past commentaries. Firstly, we have the possibility of looking at the action from late July to date as a sideways triangle, with the May to date downtrend being the top trend line and the lower time acting as the lower trend line. Personally, I thought this would be a bit of a stretch, but it is there. The second idea is to look at the August to September action as a possible double bottom. There is merit to this idea, and it could work in conjunction with the sideways triangle idea, but both would need a significant push higher. So, after all that, we are on the cusp of my drawing targets above, but not just yet. I am cautious, and I would need clear multiple consecutive closes higher, preferably over both moving averages, the downtrend and the February 2021 high at 1894 before I start placing X's. But we're not far away from doing that right now. Ice Europe white sugar in London. This one is dominated, once again, as it was last time, by the changeover gap from mid-September. One can say a lot of things about what happened beforehand, but the changeover gap on a continuous daily chart is really big. The action stretches from roughly the September 2016 high at 619 even down to the 50% Fibonacci line, the July 21 to date action at 522.80, and the congestion seen in early 2017 at 517.80. Now the actual gap is from 541 even to 603.60. But it was only late last week that a really concerted effort was made to try and fill it. It actually started last Tuesday with a move up to the capping and slowly rising long moving average, currently 536.80. Last Wednesday saw an indecisive doji cross pierce the long moving average, but open and close right on it, and it was left up to the last Thursday to make a large move higher with a bullish long white Mariposa. closing over the March 2017 high at 548.70, just under the neckline, currently 553.60, of the August to December 2021 complex head and shoulders top. This neckline I described last time, and I quote, "This neckline has acted almost like the middle tone of a mildly bullish pitchfork, as a dynamic support and resistance line. We'll see how it fares on an approach from below." End of quote. Well, the neckline and the flatlining medium moving average, currently 554.30, that's just above it, were tested last Friday with an indecisive spinning top that did not manage to clearly close above either. However, today the market punched up over both of them and into some free territory above, potentially all the way to this February 2017 high at 565 even. The question now is whether the market will exploit this break higher or not. It will be very interesting to see if prices establish themselves over the neckline or not. You see, the opportunities above from the February 2017 high are quite interesting. We have limited congestion from September between 571.20 and 573.80, and then again 579.30 to 581.5. But the next significant resistance is the November 2016 high at 589.90. And we shall see how this develops. Sugar white premium spread. There are two salient points to recognize here and 3 points to consider. They're all big picture items. The first is how the weekly key reversal down reached up so high but ended up forming a bearish pattern. It was as if the market just wanted to get to supposed targets up there, found nothing but carried on regardless until it lost interest and reverted back down, completing its operation. The second is how the upper time, currently at 224.5, the big old bullish Andrews pitchfork from 2019 to 2021, managed to capture the top of the market, admittedly after it had been breached, but still capture it and turn it back down within a week into a weekly key reversal down that closed below the middle time, currently 150.25, of the very same bullish Andrews pitchfork. This indicates to me that this large bullish Andrews pitchfork is still intact, if a little damaged, and is mending itself. Now, 3 salient points to consider going forward. The first is that we have what seems to be an ascending expanding wedge pattern formed since mid-April, currently 135.5 to 240 even. It is not the best looking pattern I've ever seen, but it is still there and it comes with all the possibilities such a pattern can evoke. The second is a possible pattern in construction. I cautioned about this last time. It is the monthly key reversal down we saw in September. Now, take this information with a huge pinch of salt, as the earlier monthly key reversal down we saw in July did not work out so well. So there's a big dose of question marks with this pattern as to whether we'll see the market follow on lower or not. The third point is twofold, and is to consider the support being given to this market by firstly the rising medium moving average, currently 141.5, and the support of the 50% Fibonacci lines of the August 2021 to September 22 move at 131.25, and the July 2019 to September 22 move at 128.75. These two moving averages have been working in conjunction with the medium moving average. These two 50% Fibonacci lines have been working in conjunction with the medium moving average in supporting the market in some of the recent attempts lower. These are the salient points to consider going forward. Some shorter term and some longer term. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final point.